Hi everyone, I'm Professor Tuttle. I'm your professor for Accounting 116A Financial Accounting. And one of the things I try to do for each chapter is I try to do some YouTube videos where I solve the static version or similar versions of your homework problems so that you have a better understanding of how to solve the problems when you're doing the homework. I figure you're using this in addition to viewing the PowerPoint presentations. So pick and choose kind of which items help you the most to help you be as successful as possible. When I do the problems like this week, I'm doing them for chapter 1. You can find the problems that I'm using in the videos by logging into Cengage and clicking on the ungraded assignment for that chapter. You can print them up or you can just follow along on the computer taking notes, whatever works best for you. Accounting is interactive. You have to interact with it, so that's why I like to put everything up on the board. So I'm going to start with problem 1-1A on transactions. And it's on April 1st of the current year, Morgan Jones established a business to manage rental property. She completed the following transactions during April. So you'll see what I have up here on my home whiteboard is the grid that you'll fill in, similar to what you're doing on your chapter 1 homework problem for this chapter. But there's a couple of things I want to touch on really quick before we actually start the problem. The first one of those is the accounting equation. And the accounting equation is that assets equal liabilities plus stockholders' equity. So you're like, okay, well, what does that mean? One, this always has to remain in balance. So let's say you have assets and you know stockholders' equity. You can solve for liabilities by subtracting the stockholders' equity from the liabilities. If you have liabilities and stockholders' equity, you add those two together and that's going to give you total assets. So what are assets? Assets are items the company owns. Right? So cars, computers, cash. So examples, cash, cars, land, supplies. These are all things that the company owns. And liabilities are amounts the company owes. So this would be things like accounts payable, salaries payable, anything with payables on it. And then item we're going to learn about later is unearned revenue. And then stockholders' equity is the difference, or it's the owner's interest in the company. And remember, we're dealing with financial accounting, so we're looking at publicly traded corporations, so they have to do things by set matters or standards called generally accepted accounting principles. Stockholders' equity is made up of two things. It's made up of retained earnings, and retained earnings are all the profits earned during the corporation's life, minus payments of dividends to the owners, minus dividend payments. And I know there's tons of new terminology that you get in these first couple of chapters. I understand that. It's as much a language class as anything else. So we've got the first component, which is all the profits earned during the corporation's life minus dividend payments. So if you wanted to look at Disney's retained earnings, that would be all the profits that they held over the years that they've been in business, less dividend payments. And then the other part is common stock. And common stock is amounts owners have invested in exchange for stock. All right, so this always stays in balance. We've got assets equal liabilities plus stockholders' equity. We're going to learn about new assets all the time. But if you look on the board here, underneath where I have assets, you can see that I've got 3 asset accounts there. I've got cash, accounts receivable, and supplies. I have 1 liability account, accounts payable, and then I have the stockholders' equity accounts, or the accounts that are going to impact stockholders' equity. So we've got common stock. Remember, those are the investments that people make for in exchange for shares of stock. We've got dividends, amount paid to the owners. We've got fees earned. That's what we're in business to do, is to earn those fees. And then we've got rent expense, salaries expense, supplies expense, auto expense, and miscellaneous expenses. And then when we get into chapter 2, we're going to break this down a little bit more, and we won't be showing the revenue and expenses in the same grid. So that's some basics to get us started. The other thing is we're going to be doing transaction analysis. So as I go through each of the transactions, I'll talk through to them, but it's important to remember that transactions always have 2 parts, 2 or more. 2 or more accounts impacted. And basically you want to think of it this way as you're learning it. What is the company giving up and what are they receiving? So that's what we're going to do right now as I start going through the transactions. So I'm going to have the camera kind of start over there because we'll be working our way. So in the first transaction, A, I'm going to put that here. They tell us that the company opened a business bank account with a deposit of $60,000 in exchange for common stock. So to open that account, Morgan Jones needed to take $60,000 in cash and take it. So we're going to increase our cash account because that's what our company received. And in exchange for that $60,000, the company gave up $60,000 in common stock. So you can see assets equal liabilities plus owner's equity. We've got cash of $60,000 and common stock of $60,000. So that's how this is going to work. So the next one we're going to look at is we purchased office supplies on account for $1,800. I'm going to put this here. So what the company did, what did the company receive? The company received $1,800 in supplies in exchange for their promise to pay, which would be an accounts payable. If it's a payable, it means that our company owes items that need to be paid. And so then what the problem wants us to do after this is they want us to give you the balance. So they're going to want you to do this after each transaction. And you'll always bring down all the account balances, make adjustments if you have to. So again, what you'll see, we have $61,800 in assets, and we have $61,800 in liabilities and owner's equity. So the third item is C. We received cash from fees earned for managing rental property for $22,300. So that's going to be here for C. We received cash in the amount of $22,300. They tell us that it was from doing what we are in business to do. So we're going to go over to fees earned, and we're going to put that $22,300 there. And then again, we need to balance everything out. So we'll have $82,300 $300. We have our $1,800 in supplies. We have our $1,800 in accounts payable. We have $60,000 in common stock, and we have $22,300. So that's our first 3 transactions. For D, we paid rent on office and equipment for the month of $7,000. So when we're saying that we paid something, that means we're using cash. So we're going to subtract the cash for $7,000. And then we're going to go to the office rent, to our rent expense here, which is also $7,000. And you'll see that I put it in parentheses. When you enter negative numbers into your grid like this, you have to make sure you put a negative sign in front of them. Okay? So now I'm going to go down and give us our balances after this transaction. So $82,300 minus $7,000 is $75,300. We've got supplies of $1,800. We have accounts payable of $1,800, common stock of $60,000, fees earned of $22,300, and rent expense of $7,000. So the next one is E. We paid creditors on account $1,100. So when you hear that, we paid one, remember that's cash, right? So we paid out. So we need to pay, we're going to pay out $1,100 of cash. And we paid creditors. The only creditor we have is our accounts payable here. So we're going to enter that also because we're going to reduce that amount as we go through. So then our new balances after this transaction are $74,200 for cash, $1,800 for supplies, $700 for our accounts payable because I reduced my accounts payable by making that payment, $60,000 for common stock, $22,300 for fees earned, and $7,000 for our rent expense. So imagine if it was Walmart and you had to do all this by hand. Computers are a beautiful thing. So F, we billed customers for fees earned for managing rental property, $3,600. So one of the things we learn about in this class is the revenue recognition principle, which is that we recognize revenue when it's earned, not when it's paid. So even though the client hasn't paid me yet, I'm going to show that I've earned those fees because I've earned them even if I don't get paid. So again, we're at F and it says we billed customers for fees for managing the rental property of $3,600. So here, when people owe our company money, that's an asset. So I'm going to increase accounts receivable by $3,600, and I'm going to increase my fees earned by $3,600. I want to make sure I get all my math right here. All right, so then our new balances are $74,200 for cash, $3,600 for accounts receivable, $1,800 for supplies, $700 for accounts payable, common stock $60,000, $25,900 for fees earned, and $7,000 for rent expense. Now we're going on to G. We paid automobile expenses for the month, $750, and miscellaneous expenses for $1,800. So we're going to combine that, and we're going to debit cash for not debit cash. I'm going to reduce cash by $1,750. We haven't gotten there yet. But then we're gonna split it up because part of that was for my automobile expenses for the month. So 750 was automobile expenses, and then 1,000 of that was for miscellaneous expenses. So again, we need to bring down all of our balances. 72,450 for cash, $3,600 for supplies, $1,800 for supplies, $700 for our accounts payable, $60,000 for common stock, $25,900 for fees earned, $7,000 of rent expense, $750 of automobile expense, and $1,000 of miscellaneous expense. So we're almost through. We've just got a couple more items here. On H, we paid office salaries, $4,000. Again, paid means we've put cash out. So for H, we're going to reduce cash by $4,000, and then we're going to put $4,000 in here. And we put it in as negative because fees earned actually increase retained earnings or stockholders' equity, and expenses have the net effect of decreasing them. So that's why we see it over here. So we've got our balance of $68,450 for cash, $3,600 for accounts receivable, $1,800 for supplies, $700 for accounts payable, $60,000 for our common stock. Whoops, oh, I didn't put in the other part of my, we paid office salaries of $4,000. So I put those in there. I did, I jumped ahead of myself, sorry. $25,900 for fees earned. I get up close with all these numbers, and then I miss them sometimes. $4,000 for salaries expense, $750 for auto, and $1,000 for miscellaneous. For I, we determined that the cost of supplies on hand was $250. Therefore, the cost of supplies used was $1,550. So what we have to do here is we have to adjust the supplies account, which currently shows a balance of $1,800. We want it to have a balance of $250 after we take this transaction into account. So we want it to be $250. This is the balance. And then the remainder is going to go to supplies expense. So they were nice enough to give us that amount. So we're going to reduce supplies by $1,550. So we reduced it by $1,550, and then we're going to recognize $1,550 of supplies expense. Again, we'll come down and redo our balances. $68,450 for cash, $3,600 for accounts receivable, $250 for supplies, $700 for accounts payable. Common stock is $60,000. Fees earned is $25,900. Rent expense is $7,000. Salaries expenses $4,000. Supplies expenses $1,550. Auto expenses $750, and then miscellaneous expenses $1,000. And then the last transaction we look at is J, which is we paid dividends of $5,000. So we paid. So I'm going to reduce cash by $5,000. And dividends reduces retained earnings, so we're going to put that in as a negative number as well. And now we can do our final balances. So when you end this, we have $68,450 in cash, $3,600 in accounts receivable, $250 in supplies, $700 of accounts payable, $60,000 of common stock, $5,000 of dividends, $25,900 of fees earned, $7,000, hopefully my pen will make it, for rent expense, $4,000 for salaries, $1,550 for supplies, $750 for auto expense, and $1,000 for our miscellaneous expense. And if you were to add these up, you would see that our assets equal the liabilities and stockholders' equity added together. So that's the first part of the problem, how they want you to, would have helped if I did my math right, $63,450. I always have to check my math. So in the second thing, it's just a sentence they ask. So stockholders' equity is the right of the stockholders to the assets of the business. These rights are increased to the owners by issuing common stock and revenues, and decreased by dividends and expenses. So then, let me grab an eraser here. Again, remember that revenue is recognized as earned at the time that the service is performed or the customer receives the product, regardless of when cash is paid. But in the second, so then they ask us to calculate out net income for April. So revenue minus expenses will equal net income or net loss. And if our revenue exceeds our expenses, we have net income. If expenses exceed revenue, then we have a net loss. So we can look on our items here. We have fees earned of $25,900. Then we have our expenses. So we're going to list those out. So I've got rent expense is $7,000. We have salaries expense of $4,000. We have supplies expense of $1,550. Auto expense of $750. And then miscellaneous expense of $1,000. And when you're listing out your expenses, you go from largest to the smallest, and then but miscellaneous is always at the bottom. So let me see here, 11, 12, 13, 14. I hate to do math in my head. Let me grab my calculator, guys. So we've got 7,000 plus 4,000 plus 1,550 plus 750 plus 1,000. So that gives total expenses of $14,300. And a net income of $11,600. This is also the basic format of an income statement. And then the final, how much did April's transactions increase or decrease stockholders' equity? It increased it, and by $66,000, because we had the common stock of $60,000, and then the 11,600 of net income less the dividends. So equity increased. We had the $60,000 of common stock. That's an increase. We had net income of 11,600, and then we have the dividends, which decrease it. So total dividends were 5,000. So we end up with a total change of 66,600. I know it's a lot of information with these problems starting out, so make sure you email me if you have any questions after you work through this. I also, in the same non-graded assignment, I have a very similar problem that you could do yourself. Help yourselves get a little bit more comfortable before you actually do your homework assignment that's listed up as problem 1-1B on the ungraded assignments. So make sure you email me if you have any questions. Please don't respond to YouTube because I don't look at those emails. Thanks, everyone.